Hey there, everyone. Welcome to Chart This with Dave Keller. It is the day after Wednesday, November 6th. I'm your host, Dave Keller, here with Market Misbehavior, coming to you from a sunny and beautiful Redmond, Washington. Whether you are happy with the election outcome, frustrated or disappointed by the election outcome, I will tell you what I told my teenage daughter this morning when she came out of her room. Hey, the sun came up today, so that's good. Having said that, a lot of other things were up today as well. Sort of the Trump bump or the Trump trade, depending on what you want to call it, very much in full force. You know, we did a webcast mid-October talking about election season, what types of stocks would probably do well or poorly, depending on the administration. And, the things that have rallied in a significant way today, not much of a surprise, right? Given financials, industrials, energy, your top three sectors, with financials up the most. So sort of those policy predictions that you would make, things like lighter regulation for banks, certainly feeling the love. Infrastructure spending, juicing industrials pretty well. Old energy versus new energy, meaning the energy sector having a bit of a bounce today. You know, what you'll find, I think, as we go through the charts today, as we sort of debrief and don't get too comfortable because tomorrow we have the Fed announcement, right? Fed meeting today and tomorrow. So as if we haven't had enough macro news impact for a week, we have the Fed meeting coming up tomorrow, and no real surprise expected in their policy decision, but certainly a lot of speculation in terms of forward-looking expectations. Some of Trump's comments about the role of the Fed and how that might change certainly could be a part of the discussion as well. So certainly a lot still to think about and digest. But the question I would say should be on all of our minds is how much of what we learn now with a Trump administration starting in the new year, how much of that has already been priced in versus how much of this is new information. And I'm seeing a significant rally today. I don't know if all of that would be completely justified by the new administration. We'll see. But 2024 has already been a pretty aggressively bullish year. So the question is going to be the sustainability of the breakouts that we're observing today. 3 of the Magnificent 7 stocks breaking out to new 52-week highs today. Others still unable to do so. A lot of stocks like financials, Discover, financial services up over 20% today. So you're getting a huge upswing in the short term. The question is, does that manifest into long term? And so I would say if you are long equities and if you're owning Bitcoin and things that are up significantly, now is the time to update your stops and make sure you lock in as much of this rally as possible, because at some point what goes up will come down and you don't want to be holding things on the way down. That's not fun at all. All right, with that in mind, let's debrief on what we learned today as investors, and after the news sort of came through and became clear that Trump was going to be the victor. Certainly made me think, all right, stocks are going to be up pretty big today, right? Just given the expectations about what that might mean for lighter regulation, more pro-business, lower tax burden type of policies that would most likely come out. And sure enough, you're seeing major risk assets pushed to the upside very aggressively. The Dow ended up about 3.6%. We're just below 43,730. The S&P 500 almost got to 6,000. And as the day was kind of progressing, I'm thinking, it's actually not, depending on how quickly, if there were another, like, it's sort of like in a football game, if there was a 5th quarter, I feel like we would have had a couple more touchdowns. So the only reason why the S&P stopped going up is the closing bell rang. And so I think that was it. So S&P did finish up about 2.5%, and that's at 59.29, a new all-time closing high for the S&P. The NASDAQ Composite testing the 19,000 level, but not quite getting there. It's still up about 3%. Mid caps, small caps, all up, and the small cap S&P 600 index up over 6% today. So again, all of this obviously a reaction to Trump winning by a much wider margin, I think was sort of the expectation or the speculation going into tomorrow. So certainly a bit of a positive surprise. And again, reminder about all the things we talk about when a stock gaps on earnings to the upside or the downside. It's not about the immediate reaction, which is something, right? That has happened. Now it's about follow through, right? Now we've all of a sudden bid up some of these risk assets significantly from one day to the next. And now the question is going to be the sustainability, right? Are there additional buyers pushing prices higher? What's motivating them, and how much has been priced in versus how much is still yet to be priced in. As a trend follower, as we've talked about, I'm going to continue to own risk assets until the charts tell me otherwise. The good news is, before today, the charts told me still hold risk assets. That feels pretty good today. However, I also want to remain diligent and remain cautious and watch for signs of distribution. The VIX on a day like today dropping pretty significantly. It was pretty much from yesterday's close to this morning. The VIX opened down just below 16, actually. It ended up around 16 and a third. That's down a full 4 VIX points and clearly well below that 20 level. So just like that, we are back in a low volatility uptrend. So again, let's see how the remainder of this week plays out with all the other macro influences that we have. Rates popping higher, the dollar popping higher today. All of that is, essentially based on, speculation. A lot of Trump's comments and likely policy priorities are most likely inflationary, right? Things like tariffs will probably end up making goods and services a little more expensive, particularly things from outside the U.S., and that'll probably be passed on to the consumer, and that probably means prices are going up. So rates going higher, the dollar going higher, all part of that inflationary environment type of thing. And again, that may not actually play out. That might be unfounded, but that's certainly what seems to be motivating the moves here. So the 10-year yield around 4.43, the long bond yield just about 4.6% as bonds sold off pretty good. The TLT was down almost 3% today. And the dollars I mentioned are moving higher as well. With the dollar and rates going higher, gold and precious metals coming down. As we'll look at the chart of gold here in a little bit, I would argue the trend is still okay. But gold got dinged by 3% today. That's using the GLD. The SLV, the silver ETF, was down 4.4%. Energy prices weren't up that much given, potential optimism in sort of fossil fuels and old energy. The USO is actually down slightly, but overall energy stocks certainly getting a bid today. A lot of movement in cryptocurrencies. We've been talking for a while about Bitcoin testing that 70 to 72,000 level. The previous highs at 74,000. All eclipsed today with Bitcoin currently trading just above 76,000. That's up about 10% from yesterday. Ethereum up about 11.25%, just below 2,700 as we're going live with the live stream. And all of the top 10 coins followed on stock charts, all in the green. And full disclosure, I do own a couple of those things. Gold, the GLD, Bitcoin, Ethereum are all things that I own. All right. Sector movements. Good time to own financials, industrials, and energy, right? As we mentioned, and as we talk about in our webcast, I think part of what you need to realize is, depending on who would win, the things that will work or not work, at least in the short term, because it's a reactionary sort of move, are going to be significant. They're usually magnified right after the event. So sure enough, financials as a sector, the XLF was up about 6.1%. The individual listings obviously up much more than that. As I mentioned, DFS was the top performer in the S&P, up over 20% today. Industrials up 3.9%. The XLE energy up 3.7%, followed by consumer and technology. On the downside, your three most defensive sectors were the only ones that were down on the day. Real estate down 2.7%, consumer staples down 1.6%, utilities down 1.1%. So, essentially that idea that we talk about often, offense over defense, clearly, generally in 2024 has been favoring offense over defense. Our ratio of consumer discretionary versus staples has been favoring consumer discretionary for a little while now. This today's move just sort of magnifying that trend that we've been observing for quite some time. Given that rally, of course, the market trend model, if today was Friday, and it obviously is not, but if it were, the short-term bearish signals that we got on Friday's close would all be reversed back to bullish. I don't formally update this model until Friday at the close. We'll see how things play out through the remainder of this week. Again, we've got a Fed meeting tomorrow. We've got a lot more earnings between now and the end of the week, so plenty more things to digest. But for now, for what it's worth, this move obviously changes a lot of the sort of short-term deterioration that we had been observing in some of the major equity averages. Looking at the mega cap leadership names, Tesla, obviously one of the big beneficiaries. Elon Musk had been campaigning with Trump and very vocal about the candidate. As a result, not surprising to see Tesla bumping pretty aggressively, with a lot of speculation about his role in a new administration, et cetera, et cetera. So Tesla, I would say overall, sort of again, still struggling to get above ultimate resistance on the chart. Not as good as some of these others, but certainly getting a nice bump today. NVIDIA and Alphabet both up about 4% as well. On the downside, Apple was actually down 1/3%. Meta Platforms essentially flat from Tuesday's close, as it were. All right, let's go to the market carpet, and you will see, generally speaking, quite a bit of green, but not as all green as you might think, and that's because certain types of companies obviously doing better than others. First step with the market carpet is sort of the heat map sort of visualization. Take a step back, sort of see what sort of configurations that we see. Obviously, I mean, a lot more green than red, and certainly some bright green, right? So a lot of names were up big today. And I would say generally, the growth sectors overall doing okay, but I'm specifically noting within consumer discretionary, not a homogeneous green kind of color. Quite a bit of a differentiation. Certainly the defensive sector struggling relative to offense, which were overall much better. Energy and financial stand out to me, besides technology, as sectors that are sort of pretty homogeneous, is mostly, if not almost all, in the green. And again, some of the big gainers that I'm noticing, like in financials, JP Morgan, Wells Fargo, Morgan Stanley, all up double digits, Goldman Sachs as well. And that's all speculation about less regulation as opposed to more regulation. That tends to be a nice a tailwind for financial stocks for sure. Second thing, look at the big dogs, the big charts, and what's happening. We mentioned Tesla, but I would say, also note how many of the other sort of leading growth names, the biggest boxes on the chart, are up pretty significantly. But also notice Apple and Meta very clearly not part of this fun. And I'm sort of an interesting outlier when you think about the broad advance that we saw with risk assets today, how well the benchmarks did. Apple and Meta apparently not as bullish of a reaction. Also within technology, semiconductors, KLAC, Lam Research, Applied Materials, all weaker than average, right? Still up and not necessarily down, but certainly not the big significant gainers. Finally, we look at some outliers or some smaller stories, and I would say within technology, obviously renewable energy. These are stocks that would have done quite well given a Harris win, but given a Trump win, SolarEdge, Enphase, First Solar most likely have a much less hospitable environment to thrive in 2025 and beyond. So the stocks selling off here. Those have not been particularly strong charts recently, to be honest with you, but certainly getting dinged here. A lot of home builders and home related names down as well. You can see Home Depot and Lowe's down around 2.5% to 3%. DR Horton, NVR, Lennar, Pulte Homes all coming off as well. This is as rates are going up. That means homes are not getting particularly more affordable. And so as a result, you're seeing some of those get dinged as well. And then finally, as I mentioned, within materials and then certainly within the defensive sectors, definitely healthcare, you're seeing a lot of stocks going down. And these are ones that probably would have done better. Certainly within healthcare, you probably assume that those would have done better under a Harris win, given Trump's victory. It's just not probably going to be as good of an environment there. So no real surprises in terms of the types of stocks that are getting a pretty good bounce today. Again, my concern with any of these things that are the brightest green is how sustainable those rallies are. Obviously, we've already priced in a lot of optimism. Today's move is sort of an exclamation point on that optimism. The question now is going to be the follow through, and what I'm skeptical of, I would say, looking at these charts go onward and never upward, is the sustainability of the move. A lot of times the promise and the expectation and the reality of implementing new policy, there's obviously a huge gap between those two. Very rarely is not a big gap. And so you wonder when there could be a wake-up call with some of these extended trends. But as a trend follower, hey, I'm going to follow trends until proven otherwise. It brings me to the chart of the S&P 500, getting to our market recap. As a reminder, I can't see questions that you pop in. So if whatever place you're seeing this live stream on Facebook, on LinkedIn, on YouTube, on X, I appreciate you very much tuning in live, those of you that are. And if you're watching the replay, I appreciate you too. If you are watching the live stream, any questions that come up, particular tickers that you'd like me to look at, pop them in the comments section of whatever platform you're on. I can see all of those here from the HQ, and I'll grab a question or two to finish off the live stream. All right, looking at the daily chart of the S&P 500, this, for me today is just a reminder of why I go with kind of the line in the sand technique, right? And so my general impression of looking at a trend like this is to define the trend, to follow the trend, and then to determine what would tell me the trend is different, right? And what I mean is having an exit strategy of some signal, some trigger that would tell me, okay, whatever I have been seeing up until that point, it's different. And as we've been talking about here for quite some time, is that 5650 level. That's the pivot point from July and August. That was the breakout that we had in September. And overall, that's a break below there would also get us below the 50-day moving average and a number of other things as well. The October swing low from earlier in the month. The reason why we do that is so on days like today, we're still on the right side of things, right? Because as long as the price keeps going up, how and when, where it does that is less important. I'm focusing on a signal that would tell me to change my positioning. We've yet to hit 5650, so I remain essentially fully plugged in and expecting prices to go higher until proven otherwise. And while we've had some short-term noise for sure, while we've had some breadth conditions that have bbeen breaking down, we haven't broken down through those levels that would tell me we're in a trend change. So today's bounce, I would say, fits into the long-term trend that we've observed through much of 2024. And again, what concerns me also about this market is the comparisons between 2024 and 2021. I mean, the charts in terms of the general trends, again, different world, different environment, but a lot of similarities from a technical perspective. And if you go to 21 to 2022, we saw how quickly the new year changed from a pretty consistent low volatility uptrend to a fairly painful protracted decline of 9 or 10 months. Now, again, different world here with the economic data that we're in, with the inflationary environment, with the Fed rate cut cycle that is now in place as opposed to where we were back then. But at the same time, it reminds me that trends can change. So again, remain diligent, remain focused on signals that would tell you the trend is reversed. Obviously, today following through to the upside. Today's bounce in stocks and lowering of volatility takes the VIX back below the 17 level, well below 20, which is sort of our cutoff. I just posted, by the way, the latest episode of our Market Misbehavior podcast. I interviewed Tyler Wood. Tyler is the co-founder of Go No Go Charts, and also the CEO and executive director of the CMT Association. We had a lot of fun. We laughed a lot and did manage to get some actual market-related discussion in there between laughter. But it was great. I mean, he's a super. I've known Tyler for a while now, and always enjoy catching up with him. He had shared a quote from another fellow CMT, Todd Sohn of Strategist, who said, "Anytime that the VIX is above its legal drinking age, that's when I start getting concerned." So again, today's move back below 21, back below 20, getting us back to a low volatility environment. And again, there's no guarantee when the VIX pops above 20 or below 20 that is a trading signal, at least in my opinion, but it does tell me about the general environment. I think one of the risks we observed late October into early November was the VIX pushing above 20. Today, obviously, with the spike higher in stocks, we have volatility coming back down, back to sort of an all clear type of signal. Newer Dow theory, given today's bounce, both the equal-weighted S&P 500 and the equal-weighted NASDAQ 100 made new highs today. And so that trend, when you have both of those sides of the market, what I consider the old economy and the new economy, when you see them both breaking out, that's bullish. That's nothing but bullish, I would say. And so the newer Dow theory, sort of a modernization of Charles Dow's original work from the turn of the 20th century, for now giving another bullish confirmation. Bitcoin obviously moving to the upside today, as we mentioned in our recap, pushing to a new high, powering above that early 2024 high around 74,000. I just want to show briefly a longer chart of Bitcoin here. This is the daily chart that I'm featuring now, a version of this, but the weekly chart is one we get to. So what's so interesting about the chart of Bitcoin, of course, you could consider this entire rounding bottoming pattern, right, from late 21 to early 2024 is this big sort of sell-off and a distribution phase and then an accumulation phase right back to the previous peaks, right? And this peak here was around 70,000. We obviously broke slightly above there, but you could argue that much of 2024 has been a test of previous resistance, right? Sort of in that 65 to 70,000 range. And this has been sort of a sideways holding pattern waiting for the breakout. And again, it's feeling more and more on a day like today that maybe this is the upside catalyst some have been waiting for, powering above to a new all-time high. And if you look back at the history of Bitcoin, that's usually when big compounding gains begin to happen. We finally break above a well-established resistance level. So overall, I would say the long-term structure pretty strong. This really is sort of a cup and handle pattern, a long one over a 3 to 4 year period. But I would say this breakout certainly is meaningful if we can hold it. And that's, I would say, a standard disclaimer for any of these breakouts that we talk about. Breaking out is important. That is obviously the first step. But validating that, confirming that with some sort of follow through is super important. So I'll be watching a breakout level like this as potential support. If we pull back after the market has had a chance to digest this, obviously pretty significant market moving news from the last 24 hours. Ripple effects from what we experienced yesterday, the dollar pushing higher, rates pushing higher. These are sort of general inflationary related conditions, right? An expectation that some of the policy proposals that Trump had been talking about have inflationary side effects, if not direct impact on higher prices. Things like tariffs usually would make things more expensive, most likely. So as a result, we are seeing the dollar push higher, not to the danger zone we've talked about from a technical perspective, 106, 107, those sort of the peaks from earlier this year and late last year. So we're pretty close, but I keep an eye on that. Crude oil prices obviously still, coming up a little bit, but still pretty low relative to where they've been. Energy stocks did get a pretty good bounce today, given what would most likely drive policy decisions going forward. But crude oil prices really not moving up too significantly. Gold coming off a bit, and that's gold's been pulling back here over the last week. So it's sort of continuing in that pullback phase. I would argue the long-term trend is probably still okay. Here's the daily chart of the GLD and ways that we consider a pullback, sort of a garden variety pullback that is still okay. Things that I would look for. We hold an ascending 50-day moving average. We hold the most recent swing low. The RSI remains above 40. If those three things are all true, then we're just not going down that much, right? And so that would mean the GLD gets below 240. That would mean we've broken below the 50-day. We've broken below the early October swing low. And the RSI in that situation most likely is below 40. So GLD around 240, that's kind of the alert that I'm setting up. I'm writing it down because I haven't done it yet. But that's what I will. That's what I would set, and I would encourage you to again define a level where even if you don't make some dramatic change in your holding, at least be aware that a trend that had been in place, something's different. We call it change of character. For me, GLD below 240, potential change of character below the 50-day moving average, an opportunity to revisit and reconsider. Interest rates, of course, popping higher today, as we mentioned, as the bond markets sold off. The dollar sign DNX, the 10-year Treasury yield, not quite to 4.5%, but getting very close there. We're now up in the range of that April, May, June sort of rotation. This is this period back here. So we have gotten back up to the previous levels of resistance. Ended up being around 4.7% at the April 24 peak. We'll see if we actually round trip all the way there. Again, higher rates are having ripple effects on things like home builders, which again would benefit greatly from the 10-year yield being much lower than this. If we see rates continue to push higher, if inflation sort of comes back into focus, and again, I think that's where the discussion with the Fed tomorrow will certainly be important. That's something to be aware of as the 10-year yield continues in a primary uptrend. Getting to some individual stocks, Tesla gapping higher, obviously with Elon Musk very vocally and visibly being involved with the Trump reelection campaign. We can see 270 was key resistance from July and from October and really from late September, right around that level. All of that in the rearview mirror now with the gap above there. So anytime you have resistance around 270 with gap above there, that immediately becomes my sort of logical support level. So I think Tesla above 270 is a pretty good chart. It is a choppy, noisy, weird-looking chart, but it is a chart primary trend going up. And I would say that that gap that we experienced here today kind of completes that. So whatever you think about the gap and the revaluation of the stock from one day to the next, the trend is up until proven otherwise. That's how I would think of it. Tesla's not the only one of the Magnificent Seven stocks breaking out. All three of these made a new 52-week high today. We can see NVIDIA in the top panel, just barely getting above that late October high. This also gets us above the June 2024 high, which was around 140. So today closing just above 145. That completes a rotation higher. Amazon finally pushing above $200 a share. That's been a sort of level of resistance, a big round number that we last faced in July, have been unable to get above there until today. And then finally, Netflix. And today's move higher on Netflix really completes that sort of consolidation, right? This gapped higher on earnings mid-October and then has been sideways for the 2-3 weeks since, but today finally sort of powering above there and making a new 52-week high. Financials getting quite a move, and I'm highlighting Discover Financial Services on a weekly chart to show the longer trend and how meaningful this is. I mean, banks like DFS and other financial companies have been trending higher through the course of 2024, at times more than others. But, DFS has been going up really since early August after a July pullback, and so really rotating higher. So today's gap is pretty significant, of course, but that's sort of following through on the gap you had earlier in 2024. This is sort of following through on that nice recovery. So the weekly charts of a lot of the financial stocks are what really impressed me at this point, improving relative strength as well. This chart is showing you the relative performance of the financial sector, the industrial sector, and the energy sector. So each one of these is a ratio of that sector ETF versus the SPY as a denominator. So the XLF making a new 12-month relative high. The industrial sector just barely making a new, we'll call it a new 6-month relative high. Energy not quite breaking out on a relative basis. So these are the 3 top performing sectors today. When you have a big change like this, I like to focus on the relative strength lines because this tells you all, it feels like a lot of things were up today. Which are the ones that are really starting to break out on a relative basis? Financials, obviously the most impressive in terms of the upside follow through, but industrials, again, some of these sectors have actually been in a decent structure for a couple of months now, and maybe in anticipation of what occurred for the elections yesterday. But for now, I would say the relative strength trends fairly constructive. It's not all good. We do have a couple charts to highlight going down. There were some things that obviously went lower. I would say Eli Lilly continuing to sell off. The problem with this chart is we've gapped lower, and instead of seeing buyers come in, we actually saw further distribution. We're still within the range of that gap day from the end of October, but we're really testing support around 750, which would be the low from early August. So this is a chart certainly in a short-term distribution phase. At least we're getting very oversold here, which could mean we get a bit of a bounce, but overall things don't tend to become this oversold unless we're in a primary downtrend that I'd assume is going to continue, most likely to go lower. So a stock like Eli Lilly stalled out earlier this summer and now really rotating to more of a distribution phase. SMCI down another 18%. That's sort of like a non-story because it keeps going down. It did actually close above the open today, so I guess that's encouraging. Last couple of days have been like this, but this is the type of chart that, again, I consider guilty until proven innocent. Charts like this, I don't think you necessarily want to be considering until you see enough signs of accumulation. One of the things I would use for that, by the way, is the Chaikin money flow. The Chaikin money flow has been generally negative for most of the last 6 months. The Chaikin money flow is a volume indicator looking at a look back period of around 20 days and looking at where we close relative to the highs and the lows and using that to weight the daily volume readings. And so overall, it's been negative sort of in distribution. Look for that Chaikin money flow to turn more green. That could be a sign of a bit of a recovery. But previous signals we've gotten have been underwhelming, again, because we haven't had that upside follow through. So something to look for. But for now, again, a chart like that, guilty until proven innocent. All right. Let's go to some of the questions. Thanks again, all of you putting questions on and all of this. I really appreciate it. Let's see. Novo Nordisk. Let's take a look. Julilo, I believe. Sorry if I'm mispronouncing your name. Asking, can you please analyze the chart of Novo Nordisk? Even after the decent earnings, it went down today. It looks like smart money is shaking retailers out before going up. Let's take a look. So NVO is the U.S. listing of that. Yeah, here we can see it. So right. So remember, there are a number of things to talk about here, a number of things to unpack here, right? What you have to remember is what impacts a stock's performance, right? In terms of the price action, it's a bunch of different things. Some of that is macro, some of that is micro. So whether or not Novo Nordisk actually, beat earnings, and again, I'm not really going to go through the earnings in detail in this type of environment, but whether or not that happened, we also have to remember there is a big sort of macro event happening, right? So pharmaceutical companies are subject to the same forces that all these other stocks are. So while financials and industrials and energy are getting bid higher. Things like pharmaceutical companies probably would have done much better under a Harris win because, they're, again, just because more of a focus on healthcare and affordable healthcare and all those sorts of things, given policy expectations. These stocks are all kind of getting beat today. Healthcare as a sector, one of the worst performers, still up, but not by much. So I would say that's part of it. The second thing, remember with stocks, and again, I can't, unfortunately, didn't do a lot of research on the fundamentals of Novo Nordisk before the show, but other things I would keep in mind. Remember that a lot of companies beating earnings, their estimates have been brought down significantly, right? So the trend in earnings estimates revisions has been clearly down. So stocks that are beating earnings, a lot of times they're beating a very much lower bar than before, right? We're sort of ratcheting down our expectations. So it's whether or not these companies are beating very sort of undervalued earnings, I guess, or undervalued estimates. As a result, it's a lot less about whether or not they beat earnings, but more about forward-looking expectations. And certainly around elections, it's not about what's happening now, and it's not about what a company just did. It's all about looking forward and what the next 6 to 12 months would likely bring. And so a lot of the pharmaceutical stocks and Novo is one of those getting dinged today, I would say, as part of more of a macro type of thing. So when you think about an individual stock, remember that earnings and all these other things are part of the puzzle. And that's why I always tell people to hold off if they talk about buying companies on certain PE ratios or certain valuations or something like that. That, generally speaking, could be a good approach. But you have to remember, if you're pulling the trigger on an individual stock in an individual day, that earnings and that valuation is just one piece of a much larger picture. And now is one of those times where it is a macro call in a lot of ways than elsewhere. Another, not really a question, but a comment: buy the rumor, sell the news. Sorry, sell DJT. I'm guessing DJ. Yeah, that's the Trump. I thought you were talking about transports. Yeah. So, I mean, obviously the Trump stock, popping higher here. But what's interesting is, while a lot of the rest of the market up significantly, DJT still up 6%, but it closed down through the course of the day. It did open around 44 and actually closed right around 36. What you just mentioned, the reason why I want to bring up your question, I appreciate that, is, buy the rumor, sell the news. That's the risk in this environment. And that's why I'm not going to tell you that this is an all clear of sorts in terms of the Trump victory and the fact that risk assets are rising. At any time I see a trend that emerges and a trend that explodes, at some point prices come down. And the question of when and how is what we don't know. But what we do know is that the prices will come down at some point. So this is a time to think about, again, we can speculate on what's been priced in and what hasn't been priced in. I'm much happier just following the trends. The trends overall are positive on a lot of things. I would not say DJT is my favorite chart out there. I think other charts like, Palantir, given the choice, I would much rather own something like this, which is a compounder and has consistently demonstrated the ability to break out and follow through to the upside. DJT is a range-bound, choppy chart at best. So regardless of what you think about, the person and the company and the expectations, I would say from a technical perspective, there are clear charts that look very good. There are clear charts that don't look as good. And I would say make sure you're thinking of those for sure. All right, let's see. LII, please. No participation was the next question. Lennox International. Yeah, so right. And again, I think some stocks certainly got bid up very quickly after the election results have been digested. Others not. So LII, which is a stock that's arguably been in a primary uptrend since early 2023. This has been just a nice, consistent gainer, and the outperformance overall has been fairly robust. It's not outperforming today because it's down 3 1/3%. However, we have to remember that the trend is still quite positive. So I don't see anything on this chart that would necessarily tell me to sell, right? I mean, the fact that we haven't broken above 620, I'd be happier if we did. If I own the chart, I don't own the stock. I would be happy about that. But again, this is still a price above 2 upward sloping moving averages. Charts like this that are down a bit, the trend is still positive. So what happens today on a big move day, a lot of charts are going to have this weird aberration. For months, we're going to be, and if not more than that, we're going to be talking about the Trump bump and this Trump gap on a lot of charts and what happens afterwards. Now that that's happened, it's all about what occurs next and making sure with charts like this, you're following the trends as long as possible. unwind positions when the charts tell you that they no longer deserve your assets. But until then, I'm happy sort of being long and strong and following the trend until proven otherwise. Folks, that's a wrap for our post-election show here on Wednesday, November 6th. I am so glad the sun came up, regardless of who you supported. The good news is the day happened, and we will all be able to move on, hopefully in a positive and uplifting way, which is how I tend to approach things. But I thank you so much. I appreciate you tuning in live if you did so, and if you're watching the replay, I appreciate it as well. Don't forget to catch my latest episodes. I've had 2 really good interviews this week that I've posted with Adrian Day of Adrian Day Asset Management. Great discussion about economics, a lot of sort of broad implications post-election that we recorded recently. And then interview with Tyler Wood of Go No Go Charts, really about systematic trend following, subjective versus objective technical approaches. Really interesting thoughts and great comments about a lot of the charts and how they've been evolving here recently. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great night, folks.